Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Lululemon Athletica. So let's get started. Now, Lululemon is essentially a sportswear, activewear, and recently businesswear company. So they are a Canadian American company mainly. That's where their sales are, but they're expanding. They're expanding into China, they're expanding into the rest of the world slowly but surely. So with their full year 2023 earnings, we can see increases in the double digits in everything. This is really impressive, right? So total revenue is up by 19%, and even in the quarter, total revenue is up by 16%. Women's revenue is up 13%, men's revenue is up 15%. So traditionally, this was thought of as a women's sort of brand, and this is something that has been changing recently. Lululemon has also been making lots of products that appeal to men and has been more widely adopted by men now. So this is something that's important because in order to grow to their maximum capacity or just to keep growing, they will need men and they will need products that appeal to men as well. So this is something that is good to see, that men's revenue is growing as well, because we know that there's wider adoption among women than men. So it's just a pretty green flag to see as of late. Now, they have in their investor relations website, for every single quarterly report and yearly report, they have an explanation for a lot of the items there. This is wonderful. Good job, accounting team, and just anyone who does investors relations, because this should be something that is included in every annual report, really, for any large-ish company. So I highly suggest that if you want to do your own research on Lululemon, you check these besides checking the annual reports, because you can get a lot of context. So here, for example, it talks about how the increase in revenue was primarily due to increased Americas and China mainland net revenue. So it just breaks it down here. It's pretty important. And you can see that the Americas are the biggest, by far, the biggest driver of money for them, of course. So that's what matters. Now, gross profit, also you can see that gross profit is improving. And some of these explanations are right here, primarily due to lower freight costs and reduced air freight. So it's important to see, it's important to check this in the long term. They are affected by things that aren't just themselves, right? So low freight, low air. If the situation changes, you can see them being affected by higher freight costs or things like higher input costs. If the price of cotton goes up by a lot, you could maybe see the gross profit change a little bit. So that's just something to note. But overall, their gross profit is really, really impressive. 59.4% of net revenue is really impressive for someone that has to manufacture the clothes themselves. So this is pretty great. Now, I'm going to take a look at the balance sheet here instead. And something interesting to note here is that they barely have goodwill, really. They paid it down, which is wonderful to see. Goodwill is essentially what they overpay for companies when they do acquisitions. And eventually, if you want to bring that number down, that will take a hit to your net income. So the fact that they barely have goodwill is an amazing sign. You can see that their inventory, however, as with many retail US companies, has been up. And this is normal, but they're working it down. You want to see them work it down because the more inventory you have, the more old clothes you have in storage, the more you'll have to liquidate them at a very low price or a very marked down price compared to what you used to sell it for. So inventory is not a great thing, but as long as the trend is downwards from now onwards, from January 2023 onwards, I think we'll be fine. The net debt, basically no debt, just a bunch of cash. That's awesome to see. We love a company that has no debt, so then they won't be needing to take away from their cash flow and their profits in order to pay down the debt. Their total assets are $7.09 billion, and their liabilities, their total liabilities down here, are $2.86 billion. And their current assets also cover their current liabilities more than fine. They're in a very healthy position in the balance sheet. And this is something very important to emphasize because I rarely see companies like that have no debt, no goodwill, and that have so many more assets and liabilities. This is something that you see maybe in some young companies that are getting ready to acquire another company, but in a lot of other companies, you don't quite see that, especially in the goodwill items. So good job, Lulu. Good job getting that balance sheet pretty much very well organized. Now, profitability is insane. The net income has been going up and up and up, and the cash from operations compared to the investments in property, plant, and equipment, which is basically capital expenditures, has also been great. Essentially, their cash from operations has just been growing stratospherically. We see this level here in 2014, 2015. It just keeps growing, and now it's shot into the billions from that 300 million level where it started at. And CapEx, while it has grown, it has tripled. The cash from operations has more than sextupled. It's probably an 8 times versus the CapEx has only gone up 3 times. So free cash flow is growing exponentially here. We love to see that. We love to see net income growing as well. We love this overall. It paints very well for Lululemon. Now, in order to estimate the future, what I'm going to do is I'm going to do a discounted cash flow model. So I am grabbing analyst estimates. We have 26 analysts here estimating revenue for 2025 and 2026. They technically reported their full year in January 2024, which is why it's listed like that. And I am then going to compare that to free cash flow. Essentially, what I am going to say is that 11% of revenue gets turned to free cash flow. That's pretty much in line with what they've been doing before. So I'm just going to roll with that number, and I'm going to plug these numbers in and say, okay, that's the free cash flow. 11% of these numbers is the free cash flow for the coming years. Then I am also going to grow these by 8%, and then I'm going to give it a perpetual growth rate of 3%. It's going to grow for 3% forever. Now, I'm going to have a required rate of return of 11%. That's 1% more per year than the market has given historically. So I want that. I think over time, that's a lot of money. And I'm going to divide it by the total number of shares out. And we get a fair value of equity of $176.14. However, adjusting for the net debt or cash in this case, which adds to the value, we get a fair value of $182.80 with net debt included. Now, let's see where the stock price of Lulu is at. Whoa! So, this number that I got back here, 182.8, this is assuming a lot of things. So it's assuming that it's rationally valued, and it's a number that you basically haven't seen since 2020, the 2020 crash, or 2019 before that. So this is quite interesting. You sometimes do see these big misalignments with very popular stocks, very high performers, and you see here the P is 30. Usually a more rational P, as some people would say, is 15 rather than 30. So it's basically a double what the market should be valued at. And even recently, it went down from a $500 level to this $374 level. So even then, it's pulled back a ton. If we were looking at this in the 500 level, it would have been inconceivable that the valuation is so far away, right? But I think there's some reasons why, and we can talk about them right now. First of all, I tried to just tweak my discounted cash flow model. Basically, it's very input sensitive, and you can do it in 2 ways. One of them is to change the required rate of return. So if you are happy getting a 7% per year rate of return in nominal terms, then the fair value will be $362.12, which is pretty close to this $374 level. So that's more in line with the assumptions that I have, of course, of the return you can expect. That 7% level, sort of. Now, the other way you can do it is tweak with the perpetual growth numbers. So if I say, okay, they're going to grow by 5% in perpetuity, then that number, the fair value, is also going to go up, of course. So this is just an example. If you keep that 3% perpetual growth rate and 7% rate of return, then it seems more fairly valued here. That's just to demonstrate the input changes here. But Lulu is a lot more qualitative than that. And you see, here I pull the statistics from my demographics and from my viewers, and it seems like we're a lot of gentlemen here and a single woman. And this is where I would say, gentlemen, if you are looking at Lululemon and you want to buy it, ask your wives, ask your girlfriend, ask any female friends you have about Lululemon. And I asked my girlfriend, and even though she doesn't like Lululemon for herself, she tells me that there is sort of just a lot of loyalty towards it, and especially towards that like upper middle and upper class sort of sector. that just really swears by Lululemon. So it seems to have a cult-like following of loyal customers, and with the launch of its footwear brand, it can also bite market share from other apparel brands. Essentially now it has sportswear, it has some business wear, which is a smaller section, but it's important and can grow. And it now has footwear, so it's biting market cap off of Nike, off of Adidas, etc. And this is the time to ask around and see why people ask Lululemon. Go to a yoga class, go to a gym, ask people if they like Lululemon, and if they do, if they swear by it, and why. This will help you determine if its popularity will be long-lasting like Apple's, or more of a fad like Aeropostale or Abercrombie & Fitch, which has recently recovered, but it took them a long time. So this is where the qualitative research really helps, because at the same time, this kind of valuation, where it was very far away from the first number I got, is something that would also show for stocks like Apple. However, Apple has such a cult following that I wouldn't ever bet against it, of course, because I think people will always want Apple products and will always want the clout that comes with it, or just the environment that comes with it. They want their Mac to sync with their iPhone, to sync with their iPad. Of course, that has value in and of itself that can't be measured in a pure cash flow model. So I think Lulu has a little bit of that, and that's very important to note. And if you are considering adding Lululemon to your portfolio, you have to do a mix of that quantitative and qualitative research. And adding the qualitative parts of it, maybe this 7% rate of return that I got may be higher. That is up to you to decide if it's worthwhile for you. So here I'm just saying, don't forget the qualitative research. This is very important, especially for brands like that depend on customer loyalty over and over, business to consumer especially. So I just want to emphasize that a lot of the things I've done are very quantitative, but qualitative research is just as important. A great book for that is called Common Stocks and Uncommon Profits by Phil Fisher. You can probably talk to a lot of people that enjoy that book. A lot of investors love the research methods there. And I think if you want to know more of how to talk to people who can give you insights there, then you can read that book, and I'll make a video on it soon as well. With that said, thank you so much for watching. I really appreciate you watching to the end of the video. If you like this, don't forget to like, comment, and subscribe. It really helps me out. And have a great rest of your day.